Right at this very moment, as you are sitting there watching this, something massive is happening in South Korea. Samsung is currently in the process of constructing production facilities that are going to fundamentally break the global silver market. And when I say break, I don't mean it might break or it could break. I mean it will break it. There is a specific part of this whole situation that should honestly terrify anyone who is currently holding onto US dollars. The thing is, the math behind this isn't just speculation or guesswork anymore. It has been confirmed. Let's go back a bit. In January, at CES in Las Vegas, the CEO of Samsung Electromechanics, a guy named Chang Duk-hyun, stood up in front of the entire world's tech press. He confirmed something that precious metals analysts have been quietly warning everyone about for months now. He said that their solid-state battery is actually ready. He stated that mass production is going to begin in 2026. He also mentioned that prototypes are already out there being evaluated and tested by their customers right now. But, buried deep inside the technical specifications of this announcement is a single number that changes absolutely everything. That number is 5 grams. Specifically, 5 grams of silver for every single battery cell. Now let me translate that number for you into the language that Wall Street really understands. Crisis. You have to understand what Samsung actually built here. Their oxide-based solid-state battery uses something called a silver-carbon composite layer in the anode. This isn't just some minor tiny component. This is the innovation. This is the thing that solves the dendrite problem. You see, dendrites are these needle-like crystals that form inside batteries. For decades, these crystals have kept solid-state batteries stuck in laboratories because they destroy the battery. But Samsung fixed it. However, without silver, this battery simply does not work. You can't just swap in copper. You can't use aluminum instead. This silver-carbon layer is about 8 to 12 micrometers thick. The thickness is optimized, it is patented, and frankly, it is non-negotiable. Here is where the math gets really violent. Think about a typical 100 kilowatt-hour electric vehicle battery pack. I'm talking about the kind of battery that goes into a Tesla or a BMW. That battery requires approximately 1 kilogram of silver. Now, look at the price of silver today. At today's price, which is $64.47 per ounce, that's the pricing for December 2025. We are talking about $1,071 in just raw silver material cost for every single vehicle. And remember, that is before you even process it, before you refine it, and before you manufacture anything. Just think about that for a second. Every single car that rolls off the assembly line with this Samsung battery technology needs more than $1,000 worth of silver. That's not for the whole car. That is just for the battery pack. And, Samsung isn't planning to just make a few thousand of these batteries. They are partnering up with BMW. They are in deep discussions with luxury automakers. They have even announced that their pilot line at the R&D center in Suwon is already actively delivering samples. Samsung SDI, which is their battery division, is targeting a range of 900 to 1,000 kilometers for super premium EVs by the year 2027. That translates to about 550 to 620 miles on a single charge. That means range anxiety is completely gone. The charging time? 9 minutes. The battery lifespan? 20 years. But here is the number that should really make your stomach drop. Global car production hit 75 million vehicles in 2024. If just 20% of that production, that's 16 million vehicles, adopts this Samsung silver solid-state technology, the EV industry alone would consume 16,000 metric tons of silver every single year. Now, I want you to compare that number to reality. The entire world produces just 25,000 metric tons of silver per year. Look at the breakdown. Mexico is the largest producer, and they contribute 6,000 tons. China adds about 3,500 tons. Peru provides roughly 4,200 tons. That is it. That is the global production. So if Samsung's battery technology hits just 20% EV adoption, it would consume 64% of the world's entire annual silver supply. And, you have to remember that those 25,000 tons aren't just sitting in some warehouse waiting for Samsung to come pick them up. It is already allocated. Solar panels consume 20% of global demand right now. Electronics take another 29%. Then you have jewelry, coins, and other industrial applications. It is already spoken for. Let me try to put this into perspective for you. Imagine for a moment that you earn $50,000 a year. Now, imagine someone comes along and tells you that they need $32,000 of those dollars, that S 64%, for a single new expense. But you have already committed that income to your mortgage, your car payment, your groceries, and your kids' education. You can't just create more income overnight. That is exactly where the global silver market is right now. The market is screaming. Silver hit $64.47 in December 2025. That is up from $31.96 just 12 months ago. That is a 103% surge. It briefly touched an intraday high of $61.44 in December before it exploded higher. This isn't speculation, folks. This is institutional money front-running what they know is coming. The ETF inflows tell the story that Wall Street really doesn't want you to see. 95 million ounces were added to silver-backed ETFs in just the first half of 2025. Think about what that actually means. Institutional investors, the smart money, the pension funds, the hedge funds, these people have research teams and inside connections. They moved 95 million ounces of silver into storage. They aren't doing that for fun. They aren't collecting it as a hobby. They see what is coming. Lease rates in London, which is the cost to borrow physical silver, are spiking. This indicates delivery stress. COMEX inventories are depleting. Shanghai warehouses are being drained. These are the warning signs that precede a supply crisis. They don't follow one. And here is the kicker. Samsung's announcement was in January, but the silver rally started before that. Smart money saw the patents. They read the research papers published in Nature Energy back in 2020. They understood the math. They positioned themselves before the headlines came out. By the time you read about it in Bloomberg or the Wall Street Journal, the easy money has already been made. Pop quiz. What happens when an industrial metal that is in a structural deficit becomes absolutely critical to the biggest technological revolution of the decade? What happens when the world's largest tech companies start competing for the same finite resource? What happens when there is no substitute, no alternative, and no way to engineer around the shortage? You are about to find out. So here is what we are looking at. A $52 billion bet by one of the world's largest tech companies on a battery technology that requires an industrial metal that is in a structural deficit. And I mean an actual physical deficit, not a speculative one. The Silver Institute projects a market shortfall of 95 to 149 million ounces for 2025 alone. That is before Samsung even scales production. That is before BMW starts mass manufacturing electric vehicles with 9-minute charging times. That is before Toyota's competing solid-state batteries hit the market with their announced 2027 timeline. This isn't a traditional supply and demand story. This is mathematical inevitability meeting industrial reality. And the clock is already running. Have you noticed something strange about your silver investments lately? Maybe you have seen the price climbing and wondered if it is just another speculative bubble. Maybe you have read articles about industrial demand and thought it sounds familiar, like stories you've heard before about commodities that were supposed to moon, but never did. Let me tell you why this time is different. This isn't about investment demand. This isn't about inflation fears or currency debasement or any of the traditional drivers that send precious metals higher and then back down when sentiment shifts. This is about physics. This is about engineering requirements that can't be negotiated, can't be substituted, and can't be wished away by central bank policy or corporate press releases. Samsung's battery uses silver because silver is the only material that works. It's not just the best material. It's not just the most cost-effective material. It is the only material. And they need 1 kilogram per vehicle. That is not changing. That is not getting optimized down to half a kilogram or a quarter kilogram through future innovations. The silver carbon composite layer is what makes the technology function. And Samsung isn't alone in this race. Every major automaker is developing solid-state batteries. Toyota announced their timeline. Nissan is working on it. Volkswagen partnered with QuantumScape. General Motors is testing prototypes. The entire automotive industry sees the same future. Batteries that charge in minutes, last for decades, and eliminate range anxiety forever. They are all going to need silver, and lots of it. More than exists in current production. More than can be mined in the time frame they are planning. More than the market can physically deliver. The squeeze has already started. The price is already moving. The institutions are already positioned. The only question left is whether you understand what is happening before the mathematical reality becomes obvious to everyone else. Because once BMW starts delivering cars to customers in 2027, and once those 900-mile range vehicles are sitting in dealership lots, once consumers realize they can charge their car faster than they can fill a gas tank and never worry about battery replacement for 20 years, the adoption curve goes vertical. And when that happens, when 20% becomes 40% and then becomes 80%, the silver market doesn't just squeeze, it breaks. This is Samsung's $52 billion bet. This is the battery revolution meeting supply mathematics. This is what happens when innovation outpaces the planet's ability to deliver raw materials. The question isn't whether silver prices are going higher. The question is whether you are positioned before the rest of the market figures out the math. Let's start with the science, because this is where the "they'll just find a substitute" argument dies. In March 2020, Samsung's researchers published their findings in Nature Energy. This is one of the most prestigious scientific journals in energy technology. The study wasn't theoretical. They built a working prototype pouch cell using a silver carbon composite anode that achieved 900 watt-hours per liter energy density. That is nearly double the 270 watt-hours per kilogram density of current lithium-ion EV batteries. Here is why that matters. Lithium metal anodes, which is what everyone else has been trying to use in solid-state batteries, grow dendrites. Those are needle-like crystals that puncture the solid electrolyte during charging, causing short circuits and battery failure. It is the fundamental problem that has kept solid-state batteries trapped in research labs for the past 20 years. Every major battery company has thrown billions at solving dendrite formation. They have all failed. Samsung solved it with silver. The silver carbon layer is exactly 5 micrometers thick. That is 0.005 millimeters. It provides 3 critical functions that cannot be replicated with other materials. First, it prevents dendrite formation through superior electrical conductivity and structural stability. Second, it maintains mechanical integrity through more than 1,000 charge cycles. Third, it enables energy density of 500 watt-hours per kilogram for electric vehicle applications. Field tests conducted in temperature ranges from negative 30 degrees Celsius to positive 60 degrees Celsius showed less than 5% capacity loss after 500 cycles. That is operating performance from Arctic winters to desert summers with minimal degradation. Current lithium-ion batteries lose 20 to 30% capacity over the same period. The silver isn't decorative. It's not a luxury feature they can engineer out later to save costs. It is the fundamental breakthrough that makes the technology work. You can't swap in copper and hope for the same results. The research tested alternatives. Silver won because physics demanded it. Now let's talk about what's already happening, not what might happen in some distant future. January 9, 2025, Las Vegas CES. Samsung Electro-Mechanics CEO Chung Duk-hyun announces prototype samples are being evaluated by clients and mass production facilities are being built for a 2026 launch. The target: Galaxy Ring fitness trackers and wearables first, then scaling to larger applications. This isn't vaporware. This is production timeline confirmation from a publicly traded company with fiduciary obligations to shareholders. January 2025. Samsung confirms they've achieved 200 watt-hours per liter energy density for their oxide-based small cells. The company describes this as industry-leading and on par with bigger conventional lithium-ion batteries, but in a solid-state form factor. Translation: they've matched traditional battery performance while eliminating the fire risk, extending the lifespan, and enabling faster charging. Then came October, the bombshell. Samsung SDI signs a joint evaluation agreement with BMW Group and Solid Power to develop demonstration vehicles powered by all-solid-state batteries. This isn't a research partnership where companies share ideas and publish papers. It's a commercial deployment agreement with Solid Power, providing sulfide-based solid electrolyte, Samsung SDI integrating it into battery cells, and BMW preparing vehicles for real-world testing. The stated target: mass production by 2027 for super premium EVs with 900 to 1,000 kilometer range. That is 559 to 621 miles on a single charge. Ko Ju-young, vice president of Samsung SDI, stated at SNE Battery Day 2024 in Seoul, "We supplied samples to customers from the end of last year to the beginning of this year and are receiving positive feedback." Think about what that timeline means. It's December 2025 right now. Commercial production is 24 months away. BMW doesn't sign evaluation agreements for science experiments. They sign them because they've seen the lab results, they've tested the prototypes, and they're preparing their manufacturing lines for a technology they know works. This is happening. Production lines are being built. Capital is being allocated. Supply chain teams are forecasting raw material needs. And somewhere in Samsung's procurement department, analysts are running calculations on how to secure 16,000 metric tons of silver annually when global production is only 25,000 tons. Here's the part most people miss about silver. It's not like other commodities. When oil prices spike, drillers activate mothballed wells. When copper surges to record highs, mining companies expand operations and accelerate new projects. Supply responds to price signals. Economics 101. But silver doesn't work that way. According to the Silver Institute, 70 to 80% of all silver production comes as a byproduct of mining copper, lead, and zinc. That means silver supply is determined by demand for base metals, not by silver prices. A copper mine in Chile doesn't increase output because silver hits $64 an ounce. They increase output because copper demand justifies it, and silver just happens to come along for the ride. Primary silver mines, the ones actually digging specifically for silver, operate at 85% capacity utilization, according to industry data. They're already running near maximum output. There's no spare capacity sitting idle, waiting for higher prices to justify activation. New mining projects take 10 to 15 years to develop from initial discovery to actual production. You need geological surveys, environmental permits, community agreements, infrastructure construction, equipment procurement, and workforce training. Even if a company discovered a massive new silver deposit tomorrow and fast-tracked every approval, they wouldn't deliver a single ounce until the mid-2030s. Current recycling infrastructure recovers only 18% of industrial silver, according to the World Gold Council's research on precious metals recovery. The rest is effectively lost, melted into solar panels, embedded in electronics, scattered across millions of devices in quantities too small to economically recover. Even at $64 per ounce, recycling economics don't justify recovery from most industrial applications. You can't profitably extract silver from a discarded smartphone or a broken solar panel. Global mine production in 2024 was 25,500 metric tons. Preliminary estimates for 2025 show 25,000 tons, a slight decline despite record prices. Why? Because the copper and zinc markets that drive byproduct silver production are soft. Base metal miners aren't expanding output, so silver supply stays flat or even contracts. Let me give you the numbers directly from the sources. Mexico produced 6,000 metric tons in 2024, making it the world's largest silver producer. Peru contributed 4,200 metric tons. China added 3,500 metric tons. These are the top 3 producers, and they're all facing similar constraints: aging mines with declining ore grades, environmental regulations limiting expansion, and indigenous land disputes slowing new development. You can't print silver. You can't create it with monetary policy. You can't substitute it with alternatives when the application demands silver's specific physical properties. Supply is what it is. The photovoltaic solar industry provides the blueprint for what's coming. In 2015, solar panels used approximately 75 million ounces of silver annually, about 2,300 metric tons. The industry recognized this was a cost problem. Silver represented a significant portion of panel manufacturing expenses, so they launched aggressive thrifting initiatives to reduce silver content per panel. They tried copper paste. Didn't work, efficiency dropped. They tried aluminum, failed, corrosion issues. They optimized, refined, and engineered every possible reduction. And you know what happened? By 2025, solar panel silver demand had actually increased to 20% of total global silver consumption, despite all those efficiency efforts. Why? Because solar deployment grew faster than silver reduction technology could compensate. Each panel still requires 0.65 grams of silver per watt of capacity, according to the International Energy Agency's technical reports. Multiply that across global solar expansion, and you get structural demand that can't be substituted away. The industry tried to engineer silver out of solar panels for a decade. They failed. Physics 1, electrical conductivity requirements 1, manufacturing reality 1. Samsung's batteries follow the same pattern: non-negotiable industrial demand meeting inelastic supply. The difference? Electric vehicle adoption is happening faster than solar ever did. Solar took 30 years to reach 20% of global electricity generation in leading markets. EVs are projected to hit 20% of new car sales globally by 2026, according to Bloomberg NEF forecasts. And Samsung isn't alone in this race. Toyota announced they're targeting 2027 to 2028 for solid-state EV batteries with 750-mile range and 10-minute charging. QuantumScape, backed by Bill Gates and Volkswagen, is developing their own solid-state technology. Solid Power has partnerships with BMW and Ford. Factorial Energy is working with Mercedes-Benz and Stellantis. The entire automotive industry is racing toward the same silver-intensive solution. They've all done the research. They've all hit the same dendrite problem. They've all arrived at the same conclusion. Solid-state batteries need materials with specific electrical and mechanical properties, and silver delivers those properties better than any alternative. Here's what keeps me up at night. This isn't one company making a bet. This is the entire global automotive industry, an $8 trillion sector producing 75 million vehicles annually, converging on a technology that requires a material in permanent structural deficit. The supply crisis isn't theoretical. It's mathematical certainty meeting production timelines. And unlike previous commodity squeezes that resolved when supply eventually responded to price signals, this one has no resolution mechanism. You can't mine silver fast enough. You can't recycle it in sufficient quantities. You can't substitute it with cheaper alternatives. The physics doesn't change. The chemistry doesn't change. The engineering requirements don't change. 1 kilogram of silver per 100 kilowatt-hour battery pack. That number is locked in by the fundamental properties of the materials involved. And Samsung just announced that they are betting $52 billion that this technology is ready for prime time. BMW is preparing demonstration vehicles. Toyota is racing to compete. The clock is running. The production timelines are confirmed. And the silver market has nowhere near enough supply to meet what's coming. The squeeze isn't starting in 2027 when mass production begins. The squeeze started the moment institutional investors read Samsung's Nature Energy publication in 2020 and understood the implications. That's why 95 million ounces flooded into ETFs in the first half of 2025. That's why silver rallied 103% in 12 months. That's why lease rates are spiking and COMEX inventories are draining. Smart money positioned years ago. The question is whether you understand the math before it becomes obvious to everyone else. Let's do the math that institutional desks are running right now, the calculation that's already moving billions. Current state. Global silver production equals 25,000 metric tons per year. Current price equals $64.47 per ounce. Market already in deficit of 95 to 149 million ounces. That's approximately 3,000 to 4,600 metric tons for 2025, according to Silver Institute forecasts. Samsung's 20% EV scenario, 16 million vehicles multiplied by 1 kilogram of silver per battery, equals 16,000 metric tons of new annual demand. That's 64% of current global production. Add that to the existing deficit, and you're looking at a total shortfall of 19,000 to 20,000 metric tons per year. But here's where it gets scary. 20% is the conservative estimate. Samsung's batteries offer 600-mile range versus 300 miles for lithium-ion, 9-minute charging versus 30 to 45 minutes, 20-year lifespan versus 8 to 10 years, and zero fire risk due to solid electrolytes replacing flammable liquid chemicals. When this technology proves itself in real-world conditions, and January 2025 confirmations from BMW suggest it already has, adoption won't stop at 20%. Think about how you make purchasing decisions. If you're buying a new car and one option gives you double the range charges and the time it takes to grab coffee, never needs battery replacement during your ownership, and eliminates any risk of thermal runaway fires, do you choose the old technology to save a few $1,000s? No. Neither does anyone else. At 80% adoption, the math becomes nightmarish. 64 million EVs multiplied by 1 kilogram equals 64,000 metric tons of annual silver demand. That's 2.5 times total global production every single year, forever. You can't mine your way out of that. You can't recycle your way out. The math doesn't work. There is no scenario where global silver production increases by 250% in the next decade. It's physically impossible given the geological constraints, the permitting timelines, and the byproduct nature of most silver mining. Here's your roadmap for the next 24 months. Pay attention because these are the inflection points where price moves happen. First quarter 2026. Samsung begins mass production of small solid-state batteries for wearables. Initial silver demand is minimal, maybe 50 to 100 metric tons. But this serves as proof of concept for institutional investors. The technology moves from laboratory curiosity to commercial reality. Expect silver to test $75 to $80 per ounce. As front-running accelerates, ETF inflows will spike, mining stocks will rally, and financial media will start publishing explainer articles about the silver shortage. Second quarter to third quarter 2026. Samsung SDI ramps prototype production for BMW demonstration vehicles. First real-world EV testing data becomes public. If performance metrics hold, and there's no reason to think they won't, given the October 2025 BMW partnership announcement, then equity analysts upgrade EV manufacturer price targets across the board. Suddenly, every automotive stock presentation includes slides about solid-state battery timelines and competitive positioning. Silver demand is still modest at this stage, maybe 200 to 300 tons. But the narrative shifts from possible to inevitable. Institutional commodity desks start building longer-term positions. Sovereign wealth funds allocate to physical silver. Mining companies announce exploration programs and capacity expansion plans that won't deliver metal for a decade but sound good in press releases. Price target for this period, $90 to $100 per ounce. The move won't be smooth. You'll get volatility, pullbacks, shakeouts designed to scare retail investors out of positions, but the underlying bid remains as large buyers accumulate on any weakness. Fourth quarter 2026. This is the inflection point. Commercial production agreements get announced. When Samsung SDI, BMW, and other major automakers commit to volume contracts, we're talking millions of vehicles over multi-year timelines. Procurement teams start locking in silver supply. They're not buying spot. They're negotiating forward contracts, off-take agreements, and strategic partnerships with miners and refiners. Industrial buyers recognize the squeeze and begin forward purchasing. A solar panel manufacturer that was comfortable buying silver month to month suddenly realizes they need to secure 3 years of supply before automotive demand eats everything. Electronics companies that use silver in connectors and circuits start hoarding inventory. Lease rates in London spike as physical metal becomes harder to borrow. COMEX inventories drain. Right now, registered silver, the metal available for delivery against futures contracts, sits around 280 million ounces. When industrial buying accelerates, that number drops fast. Once it falls below 100 million ounces, the derivative market gets nervous. Traders holding paper contracts start demanding physical delivery because they don't trust cash settlement. Price target for Q4 2026, $120 to $150 per ounce. This is where silver breaks out of its historical range and enters true price discovery. The all-time high of $49.45 set in 1980 gets taken out. The 2011 peak of $48.70 becomes a distant memory. We're in uncharted territory. 2027. Mass production begins for super premium EVs with 900 to 1,000 kilometer range. Toyota's competing solid-state batteries also hit the market. They've announced a 2027 to 2028 timeline with 750-mile range and 10-minute charging. Combined, Samsung plus Toyota production could consume 5,000 to 8,000 metric tons of silver annually by late 2027. At this point, the deficit becomes impossible to ignore. Financial media runs special reports. Congressional hearings investigate strategic mineral supplies. The administration announces initiatives to secure domestic silver production that won't deliver results for 15 years. China restricts silver exports to protect their domestic EV industry, cutting 3,500 tons from global supply. Price target for 2027, $150 to $200 per ounce, with potential spikes to $250 plus if physical delivery failures occur. This is where volatility explodes. Daily moves of $10 to $20 become normal. Options markets price in extreme scenarios. Retail investors pile in at exactly the wrong time, buying tops and panicking at bottoms. But there's a specific catalyst that could send silver into true parabolic mode, something that turns a supply squeeze into a market crisis. COMEX contract default. Right now, COMEX warehouses hold approximately 280 million ounces of registered silver available for delivery. Sounds like a lot, right? But remember, Cumulative deficits from 2021 to 2025 already total 800 million ounces, according to Silver Institute data. That shortfall has been absorbed by drawing down above-ground inventories, the metal sitting in vaults, warehouses, and private storage around the world. When industrial buyers start competing for physical metal, when Samsung's procurement teams, solar manufacturers, and electronics giants are all bidding for the same finite supply, those 280 million ounces evaporate fast. Lease rates are already spiking in London, which is a key indicator of delivery stress. When registered COMEX silver drops below 100 million ounces, the derivative market breaks. Here's what that looks like. Traders holding paper silver contracts demand physical delivery. COMEX can't deliver because the metal isn't there. They either declare force majeure, essentially defaulting on contracts, or they cash settle at prices far above current market levels. Either outcome triggers mass exodus from paper to physical metal. Price goes parabolic, not to 150 or 200, but potentially $300 to $500 per ounce as panic buying overwhelms remaining supply. Leveraged funds get margin called. Banks holding short positions face catastrophic losses. The entire precious metals derivative market, which is multiples larger than physical supply, unwinds in chaotic fashion. We have historical precedent for this. In 1980, the Hunt Brothers silver squeeze drove prices from $6 to $49.45. That's a 723% gain on speculation alone. They were trying to corner the market through futures contracts and physical accumulation. It was manipulation, and it eventually collapsed when regulators changed margin requirements. In 2011, silver hit $48.70, driven by investment demand and modest industrial growth. That rally was built on inflation fears, currency debasement concerns, and emerging market demand. It peaked when the Federal Reserve signaled the end of quantitative easing and risk assets sold off broadly. Neither of those events involved a structural deficit consuming 64% of global production. Neither involved non-negotiable industrial demand from the world's largest manufacturing sector. Neither involved supply that literally cannot increase fast enough to meet demand regardless of price. This time, the shortage is real. The industrial demand is non-negotiable, and there's no substitute. You can't build Samsung's battery with copper. You can't use aluminum. You can't engineer around the requirement. A 100 kilowatt-hour battery pack requires 1 kilogram of silver, period. Let me be crystal clear about what's happening here. Samsung just weaponized silver. A $52 billion corporate bet on battery technology has created a supply crisis that central banks can't print away, that miners can't dig fast enough to solve, and that recyclers can't recover in meaningful quantities. At 20% EV adoption, silver demand breaks the market. At 80% adoption, which becomes inevitable once range anxiety disappears and charging times hit 9 minutes, we're looking at 25 times current global production and annual demand. The smart money positioned months ago. ETF inflows of 95 million ounces in the first half of 2025 were retail investors reading Reddit threads. That was institutions with research teams, industry contacts, and access to Samsung's technical specifications. They front-ran the math while everyone else was focused on stock market all-time highs and cryptocurrency drama. Silver at $64 isn't expensive, it's early. It's the price before the world figures out what Samsung's production timeline really means for supply and demand fundamentals. By fourth quarter 2026, when volume production contracts get signed and automotive procurement teams start securing multi-year supply agreements, $120 to $150 per ounce becomes the floor, not the ceiling. That's not a prediction. That's arithmetic. 16,000 metric tons of new demand against 25,000 tons of total production, with existing deficits of 3,000 to 4,600 tons, means prices must rise until demand gets destroyed, or supply miraculously increases. By 2027, when BMW and Toyota are delivering vehicles to consumers, and the first wave of actual customer reviews hit YouTube showing 9-minute charging and 600-mile range, triple-digit silver becomes the new normal. Mining stocks that trade today at 15 to 20 times earnings will trade at 40 to 50 times, because investors will pay any multiple for growth when supply is constrained and demand is exploding. And if COMEX breaks, if physical delivery stress triggers derivatives unwinding and force majeure declarations, we could see $300 to $500 per ounce in a matter of weeks, not months. Weeks. That's what happens when paper markets meet physical reality and lose. This isn't speculation. This isn't some conspiracy theory about market manipulation or hidden agendas. This is Samsung's production timeline meeting industrial mathematics. This is one of the world's most sophisticated technology companies betting $52 billion that they've solved solid-state batteries, and the solution requires massive amounts of a metal that doesn't exist in sufficient quantities. The squeeze has already started. Silver went from $32 to $64 in 12 months. Institutional money is already positioned. COMEX inventories are already declining. Lease rates are already spiking. The warning signs are flashing everywhere if you know what to look for. The only question is whether you understand it before it's fully priced in. Because once your neighbor is bragging about their new BMW with 900-mile range that charges faster than filling a gas tank, once Consumer Reports is running cover stories about the solid-state battery revolution, once CNBC is doing special segments on the silver shortage, you're not early anymore. You're late. The battery revolution just broke silver. The math is undeniable. The timeline is confirmed. The production commitments are signed. And there's no going back. Samsung placed a $52 billion bet that the future of transportation runs on silver. Every major automaker is racing to compete. The supply doesn't exist to meet that demand at current prices. Something has to give. And historically, when industrial demand meets inelastic supply, the thing that gives is price. The squeeze is on, the clock is running. And mathematical inevitability doesn't care about your investment thesis, or your portfolio allocation, or whether you think precious metals are a barbarous relic. Physics wins, chemistry wins, engineering requirements win. Welcome to the silver supply crisis. It's already started. The only question left is whether you're positioned or you're watching.